Welcome, everyone. We are live and we are kicking off uh, a terrific topic today with Barry Brooksby, infinite banking practitioner, one of our personal favorites, and why infinite banking and becoming your own banker are stronger than ever in 2025. And so we're going to jump right into the topics. A couple of ground rules. If you have questions, go ahead and put them in the chat, guys. We got a lot of people jumping on. Great to have you. And we will try to address questions throughout if we can do that smoothly. Otherwise, we may want to defer certain questions to the end, so stick around. And I also encourage you to stick around because at the end of this presentation, there's going to be some illustrations and things that Barry's going to share that are going to really help put some numbers to the examples and concepts that I know he's going to be addressing throughout. So if you're new to the I&D tribe, I'm Steve Gibbs, co-founder. Barry is one of our key people in helping people set up infinite banking, high cash value, whole life strategies. Barry, let's kick it off. Why is infinite banking becoming stronger than ever and a really effective strategy in 2025?
The first thing I want to say is we are live, right? This is live, so we appreciate
We're
everyone.
live. Yep.
We're live. Never know what's going to happen technically. We're hoping for a perfect webinar here.
Yep.
In 2025, every mutual life insurance company that we work with, that we recommend, these top mutual insurance companies that pay dividends, they've all increased their dividends. Policies look amazing, high cash value growth. We want people that we work with to participate in those dividends. Think about this. If you have a dividend paying stock, and that dividend's coming to you every year, you're participating in profits of a company. The same thing happens with a mutual life insurance company. Mutual means that the company is owned by the policy holders. We want you to earn those dividends. And on top of the dividends, Steve, what people are going to love is they are also earning a guaranteed rate of return. We're going to get into that, but we also want to talk about problems. Why would someone even consider high cash value, whole life, and infinite banking when there are so many other alternatives out there? So we do want to talk about some problems, some concerns, and I'm sure a lot of people listening today are going to resonate with the things we talk about here in a few minutes.
Fantastic.
So let's
So,
look.
so let's dive into taking control, or I should say, looking at traditional financial advice and why it often fails to build true generational wealth has to do with taking control.
It really does. When you think about investing in your 401k, your IRA, mutual funds, ETFs, the only control you have is whether you're in or out. You're not making decisions on which stocks the mutual fund manager is going to pull into the mutual fund. You're not making the decisions on when they buy and sell those stocks. One of the key things that the wealthy do is they maintain control of their investments, control of their cash, control of their taxes to the best of their ability. But traditional financial advice, when you think about putting money into the stock market, and by the way, we're not saying don't ever put money in the stock market, but be aware that traditional financial advice, historically speaking, is broken. It's a model where the financial advisors in Wall Street, they're making money off of your total portfolio every year. So even if you have a losing year, you lose 10, 20, 30% of the portfolio, the money managers, the financial advisors, they still make money. Why? Because they do what's called assets under management. The more assets they have, the larger volume of fees that they're going to get. So they're charging fees on top of uh, on that entire portfolio. Not
Yep.
only that, but traditional financial advice of a 401k or an IRA is you can't take the money out until you're 59 and a half. If you try to, you'll not only pay the tax, and I'm talking about physically withdrawing the money, but you'll not only pay the tax, you'll also pay an early 10% withdrawal penalty. I describe it as putting your money in jail. So if you're 30 years old and you got a 401k or an IRA, you can't touch that money for nearly 30 years. That's a long time to be locking money up. And here's the other problem. When you get to that time frame of 60 or 65, whenever you want to start taking the money out, do you know how much money you're going to have? No. And what if the market crashes 10 or 20 or 30% the year or two before you retire? It's just so interesting to me that we've been told by Wall Street and these massive financial companies, the Fidelities, the Charles Schwabs, the Merrill Lynches, the JP Morgan Chase, all these investment houses to put money in these retirement plans, and there's no guarantees, Steve. To me, that just
Yeah.
doesn't line up. People want to know they've got a secure future, yet the instrument and tools that they're using to do that, there's no guarantees. It's all, let's cross our fingers and hope. The story I tell, I've been in the industry now just over 25 years. When I first started, I was doing that exact thing. I was putting my own money and my clients' money into the stock market. And a year or so went by, and my clients would call me and say, Barry, where are these double digit returns you told us we were going to get? We're not making money. Some of my clients were losing money. I was so new in the business, I didn't know what to tell them. So what I do, I went back to my mentor, the guy that's showing me these 12 and 18% returns, and this is what I need to tell my clients. And I said to him, Bryce, what do I tell my clients? They're losing money. They're not making money. What do I tell them? And his answer was the same over and over again. Barry, tell your clients they're in it for the long haul. It just went against my grain. I couldn't keep going down that path. So I wanted to find something better. And that's what we're going to talk about today. Something that provides stability, that provides uh, predictability, where you can know 30 years from now or 20 years from now how much money you're going to have. There is no crossing your fingers. So this traditional financial advice, it fails to build true generational wealth because it's uncertain. We just don't know.
So you put your money in jail. You don't know what kind of losses you're going to take. And of course, the fees are gonna, not based on whether you're losing money or not. And so those are all negatives. Things that if we've heard, if you've been around the financial community for a while, we've all heard these things. For anybody new, these are just things you're going to hear regularly. So you want an
And Steve,
alternative.
yeah, you
What's
want an
that?
alternative. And those listening, have you ever lost money? I don't care if it's the stock market or someone stole from you or it was a business deal. Have you ever lost money? And I'm going to guess that 95% of you are going to answer the question yes. How does it feel? It's terrible. You feel violated. You're like, oh my gosh, why did I do that?
Mhm.
Whatever. It's terrible. Have something in your portfolio that's a sleep well at night product, that's a sleep well at night investment. I own some stocks. I'm not saying don't invest in the stock market. Don't take some risks here and there. But what you shouldn't be doing is putting all of your money in the stock market and taking this traditional financial advice and not having true diversification. Remember, true diversification, this is something that's key, is not different mutual funds. It's not a different ETF. True diversification would be different asset classes, stocks, real estate, business, crypto, cash value insurance, like we're going to talk about today, gold and silver. These are different asset classes. And what we're going to talk about today is one of the most powerful asset classes of them all. And you'll see why here in a few minutes.
Yeah, great segue, Barry, to point number two of this discussion is really what's the alternative if you want to create certainty, if you do want to aim at intentionally cultivating generational wealth. I know we're going to dive right into the alternative, which is
Yeah,
really using your own banking system,
it is.
creating that.
Nelson Nash wrote this book, Becoming Your Own Banker. Steve's written a book. I've written a book. We've got these up here on the screen for you to purchase, enjoy, read through them, and increase your financial literacy. I love what Robert Kiyosaki said in Rich Dad, Poor Dad, which is another great book. Increase your financial literacy. By having increased financial literacy, you'll take less risk on investments, but you'll also make better decisions on those investments. Well, when Nelson Nash wrote the book, Becoming Your Own Banker, he talked about dividend paying whole life insurance. Why dividend paying whole life insurance as an alternative? Because of primary things like guarantees, access to liquid cash. You're not locking your money up until you're 59 and a half. And my favorite, you can use the money, the gains, the growth 100% tax free, because under the umbrella of a life insurance policy, there are tax advantages that you get. And think about this. If I asked you out there, there are three tax buckets: tax deferred, taxable, tax free. Which bucket do you like the most? I know
Yeah.
100% of you are going to say tax free. It's a dumb question, right? We all want tax free. But here's the
Right.
next question, and this is very telling. Personally, where is most of your money? Let that sink in, because I'm guessing that 9 out of 10 of you are thinking, yeah, most of my money is tax deferred. It's my 401k, it's my IRA, it's my TSP, it's my 403b. These government qualified accounts. You want tax free, but why is it that you have tax deferred as the majority of your portfolio? See, there's a disconnect here. So how do you get tax free? How do you get guarantees? What Nelson described in his book is, with dividend paying whole life insurance, you get these benefits all in one place. You become your own banker, and by becoming your own banker, you're able to capture more wealth. We're going to get into this as we look at some illustration numbers and go through a real policy loan, so you can see clearly what I mean by creating more wealth and capturing more money. Steve, any
Right.
feedback on
Just,
that?
what's that?
Any
Eric?
feedback on that?
Just to add, I love to ask people, you've heard of Section 401k of the IRS code. I'm wondering how many people listening have heard of Section 7702,
Yeah,
which
probably
is
nobody.
much lesser known tax provision that gives the tax treatment to life insurance, to a specifically designed kind of high cash value life insurance that we're talking about. And so I always like to challenge people a little bit. The other piece of this is that, people, the reason that everybody probably listening mostly has either, if you're starting out, maybe you don't have much at all, but if you've been at it for a while, you probably have a lot of tax deferred. And there's, of course, reasons for that. We're constantly coached that tax deferred, which is really taxable, right, is the way to go. So this is going to challenge some of that thinking as we go forward.
Don't anyone out there think that tax deferred is tax free, that somehow you're avoiding the tax? It's just temporary. What you're doing with tax deferred is you're kicking the tax can down the road. You will pay the tax, either you or your heirs, because if you pass away with tax deferred money, guess what? Your heirs still have to pay the tax in their tax bracket. Tax deferred is temporary. It's kicking the tax can down the road. What we're saying is it's better to pay the tax today. In most cases, you can have some tax deferred money, but not all your money, or not the majority of your money. It shouldn't be tax deferred. We're saying build wealth now, tax free. One of the reasons, Steve, we don't know what future tax rates will be. We don't know 10 years from now, 20 years from now. If you look at the historical tax rates in the United States from 1913 to now, 2025, the average high taxable rate is over 60%. Like, who wants to
Yeah.
pay that? And as we see government debt mounting $36 trillion, it's unfathomable, really. but how do you pay for that? And it's usually taxation. That's generally the case.
Yeah, income tax rates have been all over the place, and nobody knows what the future holds. It's really interesting though that the environment for tax deferred IRAs and 401ks has tightened up quite a bit in the last 5 years with the Secure Act. Maybe it's over 5 years now, where they actually made it less easy for beneficiaries to even deal with, IRAs being a remainder person on an IRA. So we've seen those tighten up, and it remains to be seen what will happen to tax rates. But much better to have tax free. I know you're going to dive into that more deeply as we're talking about policy design and just using this asset and how to do it effectively.
Yeah. And this might be the next topic, but people often ask, why haven't I heard about this? Or who else is doing this? My general answer when someone says, why haven't I heard about this? It's because in the United States of America, we have gotten our financial education from Wall Street. They would prefer you never learn about high cash value whole life insurance or infinite banking because every dollar that goes into a policy is a dollar that they're not earning their fees off of. It's a huge kind of marketing ploy, in my opinion. But here's what's interesting. You know these names: companies, banks, corporations. The social proof is everywhere. All these companies, all these banks, they all have high cash value life insurance. Why? Because it is guaranteed. It's what they call tier one capital. It's safe, it's predictable, it's guaranteed, it's liquid. The benefits go on and on and on. And if this isn't enough, like this social proof, there's many more companies and businesses than I'm showing here. Look at this. This comes directly from the FDIC website. You can go in to the FDIC website and you can look at every bank's balance sheet. So the first one, Wells Fargo here. We're showing that on their line item assets, look at this, life insurance assets, Steve.
Hmm.
That isn't 18 million. That is 18 billion. You have $18 billion in life insurance. Now, have you ever walked into your Wells Fargo bank and the person, the teller says to you, hey, today we'd like to share with you how you can get this amazing whole life insurance policy? No, it'll never happen. They own it. They'll never tell you about it. Why?
Hmm.
Because they want to manage your money. Here we go. JP Morgan Chase, 12.2 billion. Let's look at the next two
Hmm.
slides. US Bank, 7.6 billion life insurance assets. And this one's huge. Bank of America, life insurance assets, Steve, 24 billion. And these numbers, they're growing every year. They're
Hmm.
buying more and more life insurance assets. We want to teach you how to be your own bank. The banks have this. The wealthy have this. Corporations have this. We're here today to show you you can do the same thing. Be your own bank. That's what Nelson was talking about. Be your own bank.
And Robert Kiyosaki's ringing in my mind right now with the wealthy buy assets, which is another big part of this whole picture.
Yeah. It's huge. So amazing. So amazing. Well, Steve, what's our next topic here? Because I'm excited to get into
Well,
some numbers.
we've covered tax-free growth and we've covered, the concept and the asset itself, taking control. So really, I think if we want to get into design, if we want to get into strategy, these kinds of things, I think everybody watching is probably interested in that.
Let's do it. So, how do you get started? What do you do? Because you've got to figure out a premium amount that you want to put into a policy. The amount that you put into a policy, that's up to you. We have clients that are putting in $1,000 a month. We have clients that are putting in 500,000 plus per year. Look at your gross annual income. Somewhere between 10% and 25% of your gross annual income is what you should be putting into a policy. And don't think of this as a cost. It is life insurance. Think of it as a guaranteed investment because we're focused on cash value growth. And that's what I'm going to draw out here. I'm going to go through this. So what I have in front of me on my whiteboard is a properly structured whole life policy for infinite banking. These are not traditional whole life policies. And every time I say that, most of the time, I think of Dave Ramsey.
Well, I want to
Dave,
interject also though, Barry, this part of this is Kiyosaki's strategy for paying yourself first, which is a huge part of why you would try to capture a portion of your money in a guaranteed asset like this.
that's right. That is one financial principle that we should all be implementing. Pay yourself first. So by putting the money here, you're paying yourself first, and you never have to worry about losing the money. Dave Ramsey talks so negatively about whole life insurance, where you've got guys like Robert Kiyosaki that have it. But Dave is talking about traditional whole life, and even his numbers are very skewed. There's several videos you can look at right now on the Insurance and Estates YouTube channel where we've debunked Dave over and over again, two very recently. So we would encourage you to look at those.
Hey,
All
Barry,
right, properly.
David is asking if we'll have a recorded version of this. If anyone really does have to leave, we will have something later on. Of course, if you have questions, you're going to want to hang in. So, but I wanted to answer David and just let him know that.
Yeah, great. Every whole life policy out there has what's called base premium. And in a traditional whole life policy, 100% of your premium goes to base. And this is one thing that Dave Ramsey doesn't like. And I get that. But again, his numbers are very skewed. They're completely wrong. We want for a properly structured policy for the minimum amount to go into base. So minimum premium here. The remaining portion of your premium goes to what we call PUA, paid up additions. PUA is going to turbocharge the cash value. We want maximum cash value. So we're going to build the PUA right up to this top line. This is really important to know. This top line is called the MEC limit. It stands for Modified Endowment Contract. We don't need to get into the weeds, but the idea is as long as you fund a policy up to the MEC limit and not beyond it, now all of your growth and all of your gains on the policy can come to you tax-free. And look, we take care of that for you. I design the policies and other members of our team. We're going to take care of the MEC for you. So you're not going to MEC a policy. But if the base premium, which is purchasing the whole life insurance, is at the bare bones minimum, we need more death benefit in order for the policy not to MEC, because minimum base premium with as much cash value as you're going to put into your policy would immediately MEC the policy. So how do we raise the MEC limit? What we do is we add a term insurance rider, and it could be for 7 years, it could be for 15 years, it could be for 30 years. This term rider raises the MEC limit, but the reason we use the term insurance is because it lowers the overall cost of the insurance. Properly structured whole life for infinite banking always must have paid up additions and a term rider. And you're going to hear things out there about a 60-40 split, a 70-30 split, a 90-10 split. We like the higher splits, 70-30, 80-20, 90-10. I will say for most agents out there selling a 60-40, they're doing it because they want to earn higher commissions. So if this base premium goes up to a higher split amount on the base, like 40% or 50%, this base premium is being paid as commission.
And Barry, we had a question. Carlos raised his hand, but we don't have it set up to take like public comments, just can get chaotic. But if you want to leave your question in the chat, we will certainly try to
Yeah,
get to that.
yeah.
So I
Put it
encourage you.
into the chat. So we as life insurance agents, we're compensated on base premium. The more base premium in a policy, the more commission we earn. What we're saying here at Insurance and Estates is we're going to lower your base to the bare bones minimum. We're not commission driven. We want to do the right thing for you and all of our clients. One, because we know this is the right thing to do, but two, if we do the right thing for you, you're going to come back to us. We want volume. We're going to get policies for you and your spouse and your kids and grandkids and your friends and business associates. So we also expect you'll probably refer people to us. These policies this way are very low commissionable products because most of your premium is going into cash, and you're going to see that in the illustrations. I
Barry,
maybe saw another chat.
I don't know if you were planning on addressing any kind of health. Somebody asked what if you have diabetes, things like that. I don't know if you want to speak to that very quickly due to the question.
Yeah, there are four things. So an insurance company, when you get an approval, they're going to look at your age, your health, your income, and your lifestyle. And lifestyle is smoking, drinking, obviously, but it's also jumping out of airplanes and racing motorcycles. If someone has diabetes or they're taking some medications, they're not going to get the best rating out there, a preferred or preferred plus rating. But I've had a lot of clients. I mean, in 25 years, I've had a lot of clients with diabetes specifically that still get an approval. We want to look at your own situation, but don't count yourself out if you have diabetes or you're on medications. There's always, I should say, most of the time, there's always an opportunity with another company or a reinsurance company or maybe even a family member.
Okay, so those are some design essentials, and there's a lot of people in this business. A lot of people don't really understand even the basics of design, unfortunately. So I encourage people. It's good that you're getting this information. I've also found that in every business, you got people that are trying to do the right thing, and then maybe you have people that's not as much of a thing, maybe due to the pressure to make a living and things like that. So obviously, doing the right thing is important, right, Barry? Um, so policy design, is there anything else about policy design that you think people need to know, or do we want to move into some things, some things about money in general, keeping it moving, some of these principles that I know you want to share with people?
Yeah, we do want to talk about that, and then we'll look at some illustration. But I want to say what I've just shared in the last 3 minutes, what you're seeing here on the whiteboard, you know more now than 95+% of life insurance agents out there. Most life insurance agents don't know about this. So you can't go down the road to your State Farm guy and say, hey, give me a properly structured policy designed for infinite banking with a paid up additions rider. They're going to be clueless. And I know this because I've experienced it. And I have hundreds of clients that I hear this from over and over and over again. But like before they've come to me, like, oh, I heard about IBC. I watched some of your videos. I reached out to my local guy. They didn't know what I was talking about. So you know a lot more just with what we've talked about in the last few minutes. And Steve, what you're referring to, like the velocity of money, keeping money in motion, this
Mhm.
allows a person to create more wealth. See, if you lock your money up in a 401k or an IRA, you can't access the money. You can't there. I think there are some limits like $50,000 on a loan. But if you take a loan from your IRA or your 401k, you physically remove that money. You're no longer making interest and dividends on that. So these policies, and we're going to get into it when I go through the policy loan information, but this is a little teaser. These policies allow you to have the velocity of money in your life and create more wealth. Money in motion creates more wealth. When money is stagnant, like it's locked in gel in a 401k, there is less ability for you to create wealth. Guess who's really getting wealthy on your money? It's the money managers, it's Wall Street. They have your money. Don't just think they're just sitting on it, they're putting it to work. You're just expecting for a rate of return with the company or mutual fund, et cetera. You want to keep money in motion. I'm a real estate investor. I take policy loans to buy real estate. I took a policy loan just a few weeks ago to buy some crypto. I use the money to buy more assets and keep that money in motion.
Mm. And the banks keep money, you've touched on, the movers and shakers using their money. The banks are constantly keeping money in motion under the fractional reserve system. That sounds like something new for you guys listening. That's something to look into. Banks lend out many multiples beyond what they're required to keep in reserve. So that's a big part of this. If you're going to behave like a bank, then you're going to think about ways to keep your money working and not locking it up.
What's so interesting is if a bank is sitting on cash that they want to lend out, the cash they're sitting on, it's a liability. You think, well, why isn't it an asset? No, it's a liability because they're not putting it to work. The assets are the loans that they have. When they're lending out the money, now it's an asset. So we want to teach you, have your policy cash value working, and don't go out and make a bad investment, right? Don't get into something just to take a policy loan. It has to make sense, and we can coach you and help you on that as well. But keeping the money in motion does help you create more wealth.
And we just got to thank you on the medical health question, and also an affirmation. Somebody was saying that they've talked to a couple agents recently in the last few months, and they probably didn't get much as far as feedback on this strategy. So, and I know, Barry, you deal with that a lot. I know policy reviews come in, you end up comparing, and you often are able to conclude with the person that set up that other policy wasn't really dialed into the strategy.
It's true. I've seen it hundreds and hundreds of times where someone has a policy set up by another agent. That person will email me what's called an in-force illustration. I do a review of it, and right on that illustration, I point out the problems. And there are ways that we can do some corrections. But if you have a cash value insurance policy, whole life, IUL, which is universal life, ask for an in-force illustration. We can review it. We can show you.
Yeah. Yeah,
Should we
and it may
keep
be
it?
choice of company. It could be design. So there are different things that you might be able to show somebody that's had an illustration done.
And there are times where I'll tell a person, just keep it in place. It's good enough, or you've had it long enough, just keep it in place. But you want to know because you don't want to get 10 or 20 or 30 years down the road and recognize, wow, this thing was a leaky gas tank, and I just kept putting more gas into it, hoping it was going to get better. You want to resolve the problem sooner than later if there are, in fact, problems in a policy that you have. Steve, let's dive
Absolutely.
into some numbers. Okay, we're looking at here. This is our example client, 40 years young female. She's 40 years young. And what she's going to do is she's going to put 30,000 a year into a policy. We see the premium amount right here, 30,000, and she's putting the 30,000 in the policy through the age of 65. And you're going to notice that the first year cash value is 25,104. If this were a traditional old style whole life policy, instead of 25,104 in cash value, it would be $0 because your 30,000 premium would have gone to commission. But in this case, what is that? 80%, 85%? It's a high number. Most of the premium's going to cash, which means you as the policy holder, this 40-year young female has most of her money available for loans. And as time goes on, notice the cash value continuing to grow. At the end of the 25 years, she would have put in a total right here of 750,000. I'm going to pause here and just shift down to the next screen. At the age of 66, we're doing what's called a reduced paid up policy, RPU. We're not going to get into the weeds of that, but just understand an RPU, there's no more money going in. And that's why the 750 premium stays the same, right? It's not changing. But what about the cash value? It's still growing every year. Money's still growing, cash value. So she could decide later in life, hey, I want to use this as a stream of tax-free retirement income. We're going to get to that in a minute. What I want to point out is the amazing growth on the cash value. At the age of 66, no money goes in. The cash value, 1,590,000 grows to 1,680,000. Steve, that's an $89,000 gain, and no money went into the policy. Like, how remarkable is that? And over here on the right, she's also getting a $2.8 million death benefit. And notice the death benefit is also growing.
Mm.
Properly structured policies not only give you cash value growth, you also get a growing death benefit. This is one of the things that drives us crazy that Dave Ramsey says. He says, you only get the death benefit you initially paid for. Not in our policies. The mutual companies that we use, growing death benefit. And you're seeing it right here. It's very clear.
Yep, you were reading my mind on that one, Barry. That I really think that's an important point because it's one of the things that detractors mention, and it's really related to a very traditionally designed non-PUA type policy. And even with those policies, I question whether that actually happens. You might want to speak to that. But no, in this case, you have a growing death benefit, and the cash value is funding the death benefit as it grows.
That's right. That's right. And I'll just quickly take everyone here to the Insurance and Estates YouTube channel right here. We even titled this Dave Ramsey Loves Whole Life. But watch these videos.
By the way, we're trying to get Dave Ramsey on one of these, but it's just been a little tricky so far. So
Or we'd love to be on Dave's show. It'd be,
exactly.
yeah. But we go through it here. I go through traditional whole life numbers, even to debunk Dave with that. And then I get into the high cash value numbers, and they're even, obviously more remarkable. But let's say a person wants to get really aggressive. So what I've done here, this is another company that we use. What I've done in this illustration for our 40 years young female is I've continued the 30,000 just like normal. You see that here for the contract premium. But in year one, I'm including an additional $100,000 lump sum. People ask, can I dump a large chunk of money into a policy? And the answer is yes, we recommend you do. It's not required, but if you do a lump sum, the cash value, it increases dramatically. Matter of fact, this is kind of a fun little exercise.
Well, and this goes to a question too, Barry. Somebody's asking if you can optimize the cash value even more. I don't think that they're speaking specifically about lump sums, but this is one way. So you might want to address this, and then also, given the examples that we have, how optimized can we get with the policy? And I
Yeah,
know some of that depends on the details, right? It depends on the age and health and all that stuff. But
that is true. Those factors do come into play. Well, the optimized, and we want to look at everyone's different situation, your goals. Frankly, a 75-25 might be the right thing for you if you want more tax-free income, or a 90-10 might be better for you if you want as much cash as you can get right now. And those splits that I'm talking about, 75-25 or a 90-10, what I'm saying is 75% is PUA, 25% is base. If I say 90-10, 90% is PUA, 10% is base. Well, check this out. If I take the first year net cash value of 123,028 and divide it by the 130,000 premium that went in, over 94% of the premium went to cash value. We would consider this a 95-5. It's even better than a 90-10. Every person is going to have a little bit different situation. Health, premium amount, goals. There's not like, one size fits all. We're not giving blanket advice. We don't recommend blanket advice. We're going to look at those things individually for you. But in this case, almost 95%, which is unheard of in a traditional life insurance policy. What you're seeing here, this is like, oh my gosh, it's just gravy. It's just growing. And by the way, this policy breaks even. It breaks even in year three. 130, 160, 190, $190,000. You got all your money in the third year. Like what? It's crazy good.
So so that was a great, that was an answer to Carlos' question. Patrick looks like is asking about IULs. I know you get this question. Can you do this? Which one is better, whole life or IULs? Do you want to cover that now, or is that something we want to?
Yeah, since the question came up, we recommend whole life insurance for infinite banking. If you have an old IUL policy that does have cash value and maybe you're out of your surrender charge time frame, you still can take policy loans. The problem is if you start an IUL and you want it, use it for infinite banking, IULs have surrender charges. So the majority of your money isn't available. There are also increasing insurance costs in IUL. And again, a lot of life insurance agents don't even know about the increasing insurance costs. So if you're going to start fresh, I personally don't recommend IUL. I recommend what we're showing here today, a properly structured whole life policy, because it does not have surrender charges like an IUL. It does not have increasing insurance costs like an IUL, and it's not tied to the market. There are some years in an IUL where you're going to earn zero, where the floor is zero, and you won't make any money. The problem with the IUL illustrations, just at face value, is they show a person, Steve, making money every year, but we know that's not how the market works. There will be some years where the IUL does hit the floor of zero, and that's going to affect the cash value growth.
Mhm.
Hopefully that helps answer the question.
That's great. And I know from you, Barry, and maybe from some of our other team members that you can't, if you want to take loans in the early years in particular, that's going to be tricky with an IUL due
Yeah.
to what you just said. This is another fun question that came up. I think it was Tony asking, how big of a lump sum can you put into a policy? I don't know if you have that number handy, Barry, but how big could you go if you wanted to do a lump sum?
Today, I'm going to say, again, I don't want to give a blanket statement, but it's about 7 to 10 times your premium. So in this case, if 30,000, when I say premium, I mean all in, base premium, PUA portion, term portion. So 30,000, that's all three of those things. If 30,000 is your number, you can put in 300,000 of lump sums. That's a 10x. If your age is lower, maybe it's 7 times, but we can get really, really aggressive. So I'm not even building this one out at its maximum capacity. We could probably get about another 200,000 in here for a total of 300 or 330 in.
Some of
And
that
I've had
relates
some
to how
clients
much,
do that. They'll do a
right?
really low premium years 2 forward, but they get this massive amount of cash in the very first year.
And some of it relates to, if you're high net worth, you're listening, how much insurance you qualify for, and then
Yeah.
a multiple of that. So how much you qualify for, then there's the premium, and then let's say you 10x it. So, right, am I right on that, Barry, or is there
Yeah.
something?
So you'll notice the first year
Yeah.
death benefit in this policy is 2 million. Um, again, depending on a person's age, someone in their 30s can get a 30x multiple of their income. So if you're earning $100,000 and you're 30 years old, your human life value, what an insurance company would insure you for on death benefit, would be 3 million. It's 30 times the 100,000. If you're in your 40s or 50s, it's a 20 multiple, maybe a 15 multiple. So that same 100,000 of income on a 45-year-old at 20 times is going to be 2 million. So we're pretty much right there for this 40-year-old maxing out if she were earning 100,000 of income. If she's earning 500,000 of income and the multiple's 20, that's a what, $10 million numbers. So
And we had another hand raise. Go ahead and put it in the comments because those hand raises just pop up and then they pop off. So feel free to put that question in the comments. We also had a question about dividend rates, and I think this gets into the question of dividends and rate of return and all of these sort of financial things that people, in my understanding, kind of get hung up on. And yet it's an important question. I think it's valid, but I think it can also be somewhat distracting. Would that be accurate, Barry, or what do you want to say
yeah,
about?
it is important to understand what you're earning in a policy, right? But you don't want that to be the detriment of not getting a policy. So this illustration that we're looking at for this 40 years young female, these two companies, the rate of return on this is 5.25% tax-free. So I want to reiterate that. If you're earning 5.25% net tax-free, and then we compare that to a stock market investment, depending on your tax bracket, you would have to earn somewhere between 7.5 to 9.5% every year, Steve. And that's never having a losing year. So to earn 5.25%, let's say it's even 4.5% in a product where you never lose money, you sleep well at night, to me, that's remarkable because it is a tax-free rate of return.
Yep. And
Yep.
you can see the calculations if you guys, when you meet with Barry one-on-one, you can see, you go into later the ROR and later years, and you can see that that applies to every year. So in the early
Yeah.
years, that's going to look very lean, and then it just increases. And so if you're looking at like year 10 or 15, that's every year.
It's every year as if this 40-year young female did earn 5.25% every year for her lifetime. Steve, let's talk about a policy loan. Let's say that she wants to take a loan in the fourth year. She's sitting here on $227,000. So we're going to go back to the
Yep.
whiteboard. 227. We're going to scroll down here to our policy loan. And let's take a look at what's happening. To me, this is astounding. And this is going to come back to our conversation earlier about the velocity of money, keeping money in motion. How do you take a policy loan? How do you pay it back? How much do you have access to? So if the cash value in that fourth year is 227K, we'll go CV for cash value. Let's say that she wants to take a loan for 150,000. Check this out. The insurance company does not physically remove the 150,000 from her 227,000. What does that mean? It means that she is still earning compound interest on the full 227,000. What an insurance company does is they give you a loan. They're taking money from their general account and they really are giving you a loan. What they do is they put a lien against your cash value of 150 in this case, but they don't remove it. What that means is you're still earning interest and dividends on your total 227,000. That, my friends, is the velocity of money. So for me, when I take a policy loan for a down payment on a real estate deal, I'm making money in my real estate deal and I'm making money in my policy. That velocity of money is allowing me to create wealth in two places at the exact same time. Just how
Yep.
remarkable is that?
It's being your own banker.
Yeah.
Barry, segueing back for a second, question from Jeff about the death benefit in year 7. He's wondering why it goes down in year 7. I think that's a great question.
Yeah. And we're going to use the same illustration that we're talking about, the 227,000. Remember when I spoke earlier about adding a term insurance rider to raise the MEC limit? In this case, it's only a 7-year term rider. So this person only purchased 140,000 of whole life insurance. They're getting a $2 million death benefit. In year 8, the term insurance, it just drops off. So there's no more term insurance. And you might think, well, why don't I want a 10-year or 20-year or 30-year term rider? The longer the term rider with some companies, this isn't the case with all companies, but with some companies, there's more cost. So if we can get away with the shortest amount of term insurance, which is 7 years, we're going to do that because that's going to give you more cash value growth. And someone might say, well, Barry, I'm losing, in this case, $1.5 million of death benefit. Well, not really. And here's why I say that. Does the term insurance go away? Yes, it does. The death benefit in year 8 is 913,000, and then it grows every year. It's still growing. How much whole life insurance did this 40 years young female purchase? Only 140,000 of coverage. That's all she paid was for the 140,000 of whole life insurance. So I would say she's getting 8 times more than she paid for even after the term rider drops off. But that's technically what you're seeing happen. That 7-year term rider goes away.
Yeah, and for people that are looking at this, this is a very aggressive design, right? You might have some companies, if somebody doesn't want it this aggressive, but they want higher death benefit on the back end years in particular. I know, Barry, that you could show them an alternative in a few minutes, just with a different company and a different design. So,
Yeah, and the first company we looked at, this death benefit never reduced. But what was happening internally, these are some of the mechanics. The term insurance is going down, but the whole life is going up. So eventually the term rider drops off. You just don't ever see it. So this company doesn't have like a 7-year term per se. You still could drop it off, but we're just seeing the crossover and the death benefit always growing. So again, this is like personal goals. If death benefit is important to you, well, then we would look at some different options. But here, the 7-year term rider is in fact going away.
it goes to your expertise too, Barry. If somebody wants to do a lump sum, you're going to pick probably one company. If they aren't doing that, then you would potentially go with another company.
That's right. Yeah, that's exactly right. When you take a policy loan, you can do it online, you can call the insurance company. Number one, they do not do a credit check. No credit. Now, if you've taken a loan, you're out there listening, you've borrowed for a car, you've borrowed for a house, maybe you've done some SBA stuff. How long does it take to get approved for your home loan? And what do they ask you for? I mean, there's piles and piles of paperwork. If you own a business, there's P&Ls, there's balance sheets, there's bank statements, personal and business. They want the last 2 or 3 years of your tax returns. They want to see your actual bank statements and incomes and W-2 and 1099s, right? Here, no credit check, no application. And the best part, they're not questioning you. What do you need the money for? They don't care. And the reason they don't care is because they're using your cash value as collateral, putting a lien against it. If you die with an outstanding loan, they're simply going to deduct that amount from the death benefit. It's very simple. I tell clients you can usually get a loan direct deposited to your bank account within 3 to 7 business days. I've taken loans for many, many years. A lot of my clients take loans. It's again a way to keep money in motion.
Yeah.
Well,
This is the liquidity piece. And
yeah,
this is really, I think this is super valuable for anybody, but especially if you're a business owner, if you're an investor, having the liquidity access, and it's superior to, say, trying to leverage real estate, which is a common desire for real estate investors. It's superior to that because you're not having to even pay it back if you decide you want it to come out of your cash value down the road.
and look, I love real estate. I've been a real estate investor for the last 17 years. If you have equity in your real estate, you've got to go get a loan, whether it's a second mortgage or a HELOC or a private loan or a bridge loan from a hard money lender. You've got to get a loan. And 30 or 45 days later, they're asking you to make a payment back, right? Start that process of your amortization schedule. When you take a policy loan, just like Steve mentioned, they don't require you to pay it back. Now, we're going to tell you be an honest banker, pay your loans back. But how you pay the loans back, that's up to you. You could pay it back every 30 days. You could do a balloon payment 3 years from now. You could say, you know what? I'm just going to throw chunks of cash at it like a HELOC. When I get large amounts of income, I'll just put a portion of that towards the loan. The insurance company doesn't care. Steve, I've got real estate investor clients that do rehabs. They'll buy a property, they have to fix it up, right? Cabinets, carpet, paint, maybe some uh, exterior stuff, whatever. They've got to put it on the market, all of that. It's going to take time. They may not want to pay a loan back for 12 to 18 months. Well, guess what? They don't have to. The insurance company never comes knocking on the door. Hey, you missed your loan payment last month. That never happens. You get to pay your loan back however you want. Yep.
Yeah, and some people are asking, one person asked about a particular company. I'm not going to comment on that except to say that I'm not aware of that company. So that could tell you something. There are companies that are people maybe are turning to for infinite banking that haven't been around very long, or that at the very least we haven't tried to vet. But usually the major players we are. But the other question that came up was asset protection, Barry. Somebody asked if this is acceptable in a bankruptcy court. And what I'll say is that bankruptcy is a very complicated area. It has to do with the state and federal laws kind of coming together. But the asset protection of cash value in a life insurance policy is very solid across many states. It depends on your home state. Some home states it's protected completely. Other areas it's not as protected. So you want to check in your home state. We do have a chart that you can access from our blog page on the website that basically shows you the asset protection of all kinds of different insurance products, from state to state. And you can click on your home state and basically see a breakdown. I don't know, Barry, if you're able to access it there, you would just go to the blog, and I believe you can search creditor protection and
Yeah.
see if that one will pop up.
These last two
There you go.
questions,
So,
go to insuranceandestates.com, go to the blog,
yeah.
and you can type in whatever topic you want.
You
But
see
here it
that
is, state driven.
that top bullet point right there? It says bankruptcy and creditor protection. So I'd encourage you, I believe it was Carlos, you can go there and take it. Well, actually, no, I think that was an anonymous question. Never mind. So you can go there and take a look at that if you really want to know, because that's a huge attribute to this asset as well, is asset protection.
I was just on a call with someone yesterday. He lives in Idaho. So we came here. We came right here to the Insurance and Estates website. I hovered over Idaho and
Mhm.
learned that cash value life insurance completely exempt from
Yep.
creditors, bankruptcy. So Idaho is a wonderful state to get a policy in, but you would hover over your state.
Yeah.
It's state driven.
And keep that open for a second, Barry. So do you see it says same for bankruptcy and creditors, that it wouldn't necessarily be the case in every state. So you'd want to look at that, because that is a tricky area of law. You might want to consider relocating to a state that, offers better protection if you're in one of those that doesn't value it. But anyway, I digress. Uh,
It's a great
Barry, what
question.
other goodies do you have for everybody today, or are we at the tail end of this? What's your thought?
No, man, we're just getting started.
Okay, all right. I don't want to close out we're glad we still have a really good crowd with us. So, thank you guys for continuing to want to learn about this. We're passionate about it. And it's great to pick Barry's brain on these things. I always enjoy it, even after all these years. So,
Yeah. What I want to point out is this, just to kind of wrap up the velocity of money conversation. When you do take a policy loan, you're going to set up some type of payment back, whether it's any of the ways I described, right? As you're paying that money back, the balance of the loan is going down, which means you're paying less interest over time. But what's happening with your $227,000 of cash value, it's over here still earning compound interest. And compound interest, the eighth wonder of the world, we've heard that, means that you make more money year in and year out. So if you've got over here on the loan side, you're reducing the balance of the loan. It's going down. Loan rates right now with the companies we use are somewhere between 5 and 7%. So if you're compounding on the growth of the whole cash value, you still come out ahead. And this is a video that we've done on the Insurance and Estates website. You can also go to the YouTube channel, just type in policy loan, and you'll see me go through this in more detail. The overall effect of taking policy loans is that you have a positive, I'm just going to say ARB, a positive arbitrage. You come out ahead, you've created more wealth, you're using the velocity of money, you're making money in two places at the same time. If you're using that money for other assets, to buy other assets, policy loans are powerful, yet you get to decide how you pay those policy loans back.
Yeah, and people get confused about that because they properly point out that you're paying some interest on a policy loan. So I like that you're talking about the net effect with with the growth and the cash value that continues to grow. I think that's a question that oftentimes comes up for people.
And this is a financial principle everyone should be aware of. There is a difference between principal reduction and compound interest. So understanding how those two correlate with one another will help you understand why are you getting positive arbitrage on your cash value, even though you have a loan. One of the last things I want to wrap up with, Steve, we're going to come back to our 40 years young female example. And now we are going to talk about something extremely powerful, which is future tax-free income. We've talked about how you can use a policy loan right now to be your own bank and throughout your working years. But what do you do with a policy when you're retired? How do you begin taking income from a policy when you're like, I don't want to put any more money into it. I'm done working. Now I want to enjoy my life. I have these different assets. I have market money, I have real estate money, I have business money, I have pension, I have social security, whatever those assets are that are providing income. Now you can also say, I'm getting tax-free money from my high cash value whole life policy. And I think there was a bullet point on this, Steve, on your outline there of how do you use this in the future. I just want to make sure that I'm not leaving anything hanging on what we want to review here.
Yeah, no, I think you're covering it, Barry. So I don't think you're
Awesome.
missing anything on that. I
What we're
believe
going to
me,
show,
I'm trying to be the watchdog and try to gather
yeah,
any of the crumbs that you miss right now. So
okay, and checking the chat for questions.
yes,
We, we,
quarterback in
we
the chat.
remember this 40 years young female, she put in 30,000 a year through the age of 65, and the total cumulative premium that she put in was this 750,000. Okay, that's all she put in. At the age of 66, no premium going in. At the age of 67, no premium going in. And now she wants to start taking income at the age of 68. And this is where we're going to focus right here. I hope everyone is paying attention because what I'm about to show you is huge. If you get to retirement and all you have is 401k money and IRA money, I mean, plus some Social Security, right? If you get to retirement and all you have are government qualified plans that are 100% taxable, that money is not all yours. So if you got 1 million, 2 million, 3 million, 5 million in qualified plans, you got to figure that 25 to 35% of it is going to go away. It's going to go away because of taxes. What we're saying here is this is a plan that's going to give you tax-free income. Well, what I've designed here, Steve, is 115,000 a year of tax-free money. And how long does she have this money coming to her? Through the age of 90. Okay, we assume she lives to the age of 90. That is
Yep.
5, 10, 15, 20, 23 years. 23 years of income. Now watch the calculator. 23 times 115,000. She put in 750. She gets to take out 2.64 million, 100% tax free. And in retirement, she doesn't pay any of that money back. It comes off of the death benefit when she passes away. 750 in, 2.64 million out. You people, I mean, just consider what that means. And now, how would this look in your own financial portfolio? What if you put in half that amount and you wind up with 1.3 million? What if you put in double that amount and you wind up with 5.2 million? And Steve, the last thing I'll say here, 2.6 million tax-free for most people is going to spend more like 3.2 million taxable. So we're talking huge benefits here. 3, 4 times the amount of tax-free income than she put into a policy. And all along the way, her money wasn't locked up in jail. All along the way, she was earning guaranteed returns and dividends. All along the way, she had a permanent death benefit. You don't get this in a traditional financial plan that's stock market based. Boom, there you go.
This is one of my favorite strategies that we've talked about so many times. I love the fact that, and people might want to just stare at this for a second. Love the fact that they can draw down tax-free on this policy with no impact in later years and have an incredible basis of living wealthy and tax-free income. And it's just such a powerful strategy.
Agreed. This has been fun to go through. We are going to encourage everyone listening, look at your own numbers. And maybe you're a client of ours now and you're considering another policy on yourself, a family member, maybe you've got some friends that you want to refer over. But as always, look at your own numbers. We recommend that you consider the premium amount you want to put in. How long do you want to fund a policy? Is death benefit important to you? How much cash value? When do you want to take policy loans? All these things come to you specifically. We want to help you specifically. So look at your own numbers.
I encourage that as well. And wherever you're watching, you can locate Barry on our Pro Client Guide page. There may be a link where you're watching. We're gonna blast the recorded version of this out, put it on our YouTube channel, send you guys links. You'll be able to watch it again. I encourage you, if you're ready to look at your own numbers, do a one-on-one with Barry and keep the learning process going. So thankful to connect with all of you today. It's great to have our INE community showing up in force to learn about these strategies. It's why we're here. We're passionate about it. We want to empower you all. And thank you again for coming, for all the great questions. I'm going to do a quick look here and see if we do have a few questions. Thank you, Carlos. Love the props. You've been a great participant. Carlos is asking how many policies can you get during your lifetime? Again, it's kind of a fun question. Barry, you want
Well,
to tackle that one?
yeah, I mean, as many as you can get approved for up to your human life value. Nelson Nash, the gentleman that wrote the book we showed earlier, Becoming Your Own Bank, he passed away a few years ago. He had policies on him, multiple policies, his spouse, his children, grandchildren. I had heard, I had the opportunity to meet him one time in Nashville. I had heard that he, upon his passing, that he owned about 50 policies, not all on
Yeah.
himself, but I personally, I have multiple policies myself, but it's up to your human life value, or they're going to look at your income threshold as well.
Yeah. Love that. Lots of thank yous. Also, here's a question. Let's see. How long after the policy can get a loan? That can be very quickly, right, Barry? For people that are wondering that.
30 days. Could it be sooner? Yeah, but we would rather under promise and over deliver and just tell you 30 days or longer.
And Ronald's 30 days. And now with IULs, that's not going to be this. This is one reason why the mutual whole life, among others, is superior for this kind of a strategy. And then Ronald is asking, where can I get the bank statements? He's asking from the FDIC. I'm not sure if you've got the financials from the actual bank's website, Barry, or do you know where people can go to look at?
Go to the FDIC website. You've got to drill down pretty far, but you're looking, there's a search feature in the FDIC website. You've got to search each bank individually, and then you're going to click on their most recent quarterly statement, their quarterly numbers. And within that, you've got to drill down. Just watch the recording here, and you'll kind of see how to get there. It's difficult to find. They don't want people to know easily how to find those numbers, but I pulled those off directly the FDIC website.
Yeah, and here's one I missed from one of our anonymous attenders. How does this work for if you want to use this to cover a college loan for children? Fantastic question.
Yeah.
It's a terrific strategy that we paint the picture for people that it has a lot of benefits over what you would be exposed to with a traditional, maybe traditional route like a 529 plan or something. So, um, do you want to speak to that, Barry? If you had somebody planning for college, it would be fairly similar, right? And then you have the loan drop downs like what you illustrated.
Yeah, that's right. You would show, 4 or 5 years of loans. What I've told my kids is when you land good jobs, you're going to pay those loans back because upon my passing, you're going to get death benefit. So you can pay the loan back as the parent, but you really want to teach your children correct financial principles. And when they've got the job, they're making good income, you have them pay the loan back. But it is the same idea. Instead of
Yeah.
buying an asset, you take a policy loan for college. Same principles apply.
And it can become part of their legacy. So you gave them college funding along with legacy planning, a lot more flexibility. And so many more options than just your traditional, your 529 or whatever. Joy has a question coming in the ninth inning here. How does a business buy life insurance? Are they covering employees' property? What would the business? That could be a webinar in and of itself almost. But do you want to touch on that, Barry?
Yeah, and Steve, you and I just did a podcast last week or the week prior about business acquisitions and how business owners use policies for Joy, go to our YouTube channel. That's a brand new, fresh podcast that we just launched.
Yeah.
We do recommend if you have employees and you want to protect money, grow money guaranteed, have access to the cash, businesses can own policies. I've had a lot of clients that own businesses get policies. The business owns the policy. You, as the business owner, can control the cash value. When the person passes away, who is the insured party of the life insurance policy, passes away, the death benefit goes to the business. And frankly, this is what these wealthy families have done. The Rockefellers, the Rothschilds, the Kennedys, they buy these massive whole life insurance death benefits, use the cash value. But when that family member passes, the money goes into the family trust. What we're saying is if you have a business, the money goes back into the business. So it's a
Yep.
great way to propel the business, but also a great way that if you've got a key employee or a key partner in the business, there's some death benefit there that's going to keep the business going. And in most cases, probably give you more than what you would have had otherwise.
Great. Well, guys, check out the other videos on the channel. This will be there soon. Joy says thanks. Thank you for the questions. Terrific participation. We appreciate it and are energized by it. And with that, I encourage you guys, again, look at your own numbers. Do continue to do the good research. Check out the resources on the site. They're there for you. And with that, I'm sure we'll see y'all in a live webinar soon. Thank you again, Barry. It's been
Yeah.
great. All right. So I'm going to sign off. Thank you all again.
Thank you, everybody.